Adjusting journal entries. This is for Accounting 4A for the online students. And just in Chapter 3, we talked about adjusting journal entries. You can divide them up into 4 basic types. You have your expenses here, your revenues, and we'll have a section for deferrals, and we'll have another column for accruals. Okay. And an easy way to remember is deferrals, also known as prepaid. You have cash first or before, while accrual deals with cash last or after. So deferral, cash before. So with the deferrals, you would actually get pay the cash before you incur the expense. So prepaid expense would be type 1. Type 1, prepaid expense, meaning you pay the cash before you actually incur it, so consume it or use it. And our second type, deferrals, revenues, would be unearned revenue. This means that you receive the cash from the customers before you actually earn the revenue. Okay? Type 3, under the accruals heading and expenses, would be accrued expenses. And the last type would be type 4, which would be accrued revenue. So accrued expenses, you are going to incur the expense before you pay the expense, and accrued revenues, you are going to earn the revenue before you actually receive the cash, so cash after. Now with the adjusting journal entries, you have what? The next big question is when. When do you prepare adjusting journal entries? Well, adjusting journal entries are prepared at the end of the period, whether it's the month, the quarter, or the year, before you prepare the financials. So you prepare the 4 various types of adjusting journal entries before you prepare your financial statement. And then the next big question is why? Well, you want to follow the rules. So you to follow GAAP, generally accepted accounting principles, to make sure that your statements are in accordance with the accrual basis of accounting. And that requires you to follow the revenue recognition principle, and also to follow the matching principle, which were both discussed in the notes. So why? To follow GAAP and make sure that your financial statements are under the accrual basis of accounting, both adhering to the revenue recognition principle and the matching principle. And the last question is how. So going back to what we had 4 types: prepaid expense, unearned revenue, accrued expenses, and accrued revenue. The first one, prepaid expenses. you will have your initial entry, your initial journal entry. So your initial journal entry will require you to pay cash up front, and then you will recognize the asset account. So it'll be some prepaid expense. So you'll debit prepaid expense, you'll credit cash for the amount of expenses you plan to use in the future. And then, at the end of the period, you will have your adjusting journal entry to recognize the expenses that have been incurred. So then you will debit the expense for whatever dollar amount that has been used as of the last day of the period, and then you will credit your prepaid expense account to decrease the asset for the amount that was used for the period. You will see there's an example dealing with supplies, insurance, and depreciation that was discussed in the lecture notes. Second one is unearned revenue, which is an example of a deferral. Okay, so unearned revenue, you will have an initial entry, initial journal entry, at which time when you receive the cash, you will debit the cash on whatever date that is. What's today's date? Today is September, let's say September 1st, and you will debit the cash for the dollar amount that you receive from the customer. You will credit unearned revenues for the dollar amount received. Then, at the end of the period, you will record the adjusting journal entry. Since you deferred when you recognize your revenues because you hadn't earned them yet, you'll wait to the end. So the last day of the period, which will be, September 30th, you will debit unearned revenues, and then you will credit the service revenues account for the amount of revenue that you've actually earned as of the end of the period. So type 3, accrued expenses. With accrued expenses, you will actually have an adjusting journal entry first. You won't have the initial entry because you haven't received the cash. Remember? Cash is afterwards when it comes to the accrual. So it's after you incur the expense. It's after you earn the revenue. Okay? So there's no cash involved in the adjusting journal entries. Never adjust cash. What we're going to do is we're going to incur our expense. So we're going to go ahead, let's say on September 30th, we just find out that we, let's say, we have a PG&E bill coming in. We would debit the expense, utilities expense, and we would credit some payable account, probably account payable for the amount that was owed. Okay, so for the amount that was owed, we're going to go ahead and debit expense, credit accounts payable. That way we recognize the expense that should be matched to the related period for the current period. So we'll have our subsequent entry, and this will be done sometime in October. So let's say October 15th, we see the bill and we decide we're going to pay it. So at that point in time, we're going to debit account payable, AP, for the amount that we owe, and we're going to credit cash because we're paying the cash. So we had adjusting journal entry at the end of the period, and then we had a subsequent entry where we actually paid the cash. Okay, the last type of adjusting journal entry was accrued revenue. With accrued revenue, again, we're getting the cash after we've actually earned the revenue. So here we're going to do the adjusting journal entry first. So at the end of the month, we're going to see if there's any revenue that we've earned but we have not recorded yet. So what we'll do is we'll talk to our workers and find out if we've earned any of our revenues. And if we have, we're going to go ahead and debit accounts receivable. Because if we've done the work, we've earned the revenue. So we're going to go ahead and recognize the receivable account, and we're going to credit service revenue for the amount that we've earned. And then the subsequent entries, as we're dealing with an accrual, will happen sometime in October. So let's say October 20th, one of our customers that we accrued for, they go ahead and send us a check. So we're going to debit cash for the amount of cash that we received from that check. And then we are going to credit or decrease our accounts receivables for the amount of the check that the customer paid. And we will have received the cash for the revenue previously recognized. So those are briefly the four formats, the four types of adjusting journal entries. You can use this to study from. And just remember that the deferrals will have an initial entry, initial journal entry, and they will have the adjusting journal entry afterwards. The initial journal entry will involve cash, whereas accruals, they will have their adjusting journal entry first, and then they'll have a subsequent entry with the cash afterwards. And the cash will come when the subsequent entry is recorded. Okay? So, if you have any more questions, post it in the Blackboard discussion area. See you later.